The market feels like it's getting to a tipping point as we approach this week with not only more mega cap tech earnings, but sprinkle in a little bit of volatility from the FOMC announcement, Jerome Powell's press conference, and the PCE inflation numbers scheduled for Friday, and suddenly things start to get pretty spicy out there. It's another week to really buckle up, stay grounded in our process, and build a roadmap for the coming week's worth of trade that is based on the data and not necessarily our feelings. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we're certainly dealing with an inverted hammer where in the upper wick the sellers are able to step up and they push prices back down underneath the midpoint of this week's range, but they're unable to close underneath the opening print, hence the nature of the green-bodied inverted hammer. So it's definitely bearish, and we do have to respect the selling pressure at the top of this week's range, but it's not as bad as it could have possibly been. The most important thing to take away from structure here is the major change in tone. We have not seen a weekly inverted hammer in quite some time at the top of a range, right? If we scrunch this up and just remember what inverted hammers do, there's an inverted hammer, basically marks the all-time high, leads to a substantial pullback. Inverted hammer, substantial pullback. Inverted hammer, substantial pullback. What do we see back here? Back to back. Inverted hammers, substantial pullback. Now, once again, I'm not advocating that the market's going to fall off of a cliff here. Obviously, we're under much different circumstances here than we were in all of these previous examples. However, the change in tone is worth pointing out. Every other weekly green bar throughout this run has basically closed at the highs, highs, and highs. So change in tone, you need to respect that out of the weekly structure here. Now, it's like the sellers are basically saying, hey, easy does it with the higher highs and higher lows, which is kind of ironic because on the bar-to-bar count, what did we produce? A substantial higher low as well as a higher high. So where do the sellers start to get a little bit of a foothold here on the weekly time frame chart? It's if we can take out the previous week's low and usher in a lower low and some sort of lower high on the bar-to-bar count. Now, this, of course, comes to mind. This was a weekly range, right? What does this weekly range tell us? There's certainly the opportunity for weekly support over the top of the range. On the daily chart, we know that level to be 444. We'll get to that in just a moment. That's going to be a key component here, even on the weekly time frame, because of the time that was spent in this sideways range. Just as a reminder, we're certainly still in an overall weekly uptrend with lows, higher lows, higher lows, higher lows, and I would call these soft higher lows around 430. The reason they're soft is because we didn't actually flip into a daily downtrend in this area. Instead, the market really just went sideways. Remember that in this area, the market actually did flip into a daily downtrend, although very short-lived, we did make a lower low and lower high sequence on the daily time frame chart. So what does that mean? It means coming from the higher high over here, we can afford a higher low pullback that is anywhere above this area around 403. And as we know, the magic level on the weekly time frame chart has been for weeks and weeks on end now, 420. So am I expecting this in the coming weeks worth of trade? The answer is no, but understand that we can produce a higher low anywhere above 420. We know that we have confluence if we throw on the anchored VWAPs. There they are, slowly going to, pair nicely with that 420. And if we take out our volume profile, lo and behold, your high volume node is at 420. You also got to break up and over this high volume node, obviously not in the previous week's worth of trade, but the week before that. So is it possible that the market could turn what was once resistance back here into newfound support as we're testing it from the top side down? To me, the answer is yes. And once again, on the daily, we'll see that as the 444 pullback. We're rejecting in the upper wick of last week's worth of trade this overhead high volume node. So everything's making sense here from a structural and study perspective. If we take out the Fibonacci's, I'll just leave you with a couple perspectives here, then we'll move to the daily. You'll notice that we're still well above the 61.8. Even if we do pull back to the soft set of higher lows on the weekly time frame, it's 430, it's the 61.8, it's prior structure. And if you extend this to the left, it's also prior structure from over here. Could we get a weekly higher low there and then continue the daily and weekly uptrend? Sure. Absolutely. And as we know, the more time we spend over the 61.8, the higher the likelihood is that we do see a 100% retracement. Can also take out the fibs from the low up to the top. Let's just say that this does mark the tippity top of the rally. Where's your 38.2? Folks, I can't make this up. The 38.2 is at 420, 419, 415. Let's not split hairs here. It's the magic weekly zone. So Weekly chart remains healthy. There's a change in tone. Let's take a look at the daily. Let's first evaluate the expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 458.37, and that of course would imply a higher high. If we're contained by the lower bound, the number is 445.98, and that would be a big time higher low. So expected move does strike me as being more bullish than bearish. I also like the fact that the lower bound is above our key daily zone at 444, or the gap fill reversal off of 443. Another nice bullish note here, noting that again, the options market isn't even pricing in a full move towards this area. But that brings me to my next concern. Why is the options market not pricing in more volatility, considering that we have the Fed, we have PCE, and earnings will continue obviously throughout the duration of this week? So I wouldn't hold your breath at the lower bound of the expected move or at the upper bound of the expected move here. I think that we could easily breach and close outside of the expected move this week. So play with structure, not necessarily confluence with the expected move. Now, where is your daily trend? Daily trend is certainly up. We know that we just produced a brand new higher high on the Wednesday session. So in the trend sequence, we can certainly afford to pull back and search for a higher low. We know the key level to be 444, the gap fill reversal at 443. But let me also remind you, as long as the higher low is above this set right here at 436.75, we technically, it wouldn't be pretty. I will fully concede that it would not be pretty, but we could technically find higher lows at 439.75. The reason that I wanted to bring this up in today's session is because if we zoom out, I want to show you something. We don't oftentimes use the trend channel tool on the videos here, but if we do something that looks like this and like this, so basically what we've done is there's the beginning, there's your anchor of the trend channel, and you can see the top of the channel gets touched 1, 2, 3, 4. We're at the upper bound. So ask yourself the question, is it logical that the market could pull back from the top of the trend channel? Yes. Is it logical that you want to be a new money long at the top of the trend channel? No, you absolutely do not want to be a new money long up there. And as a matter of fact, if we move towards the midpoint of the trend channel, over time, that's slowly going to be right around that 439.75 area. But wait, it gets even better. If I zoom in, we can do it on this secondary minor trend as well, coming in like this, doing the same exact thing with the top of the trend channel. So here's your beginning. There's the anchor to set the trend line on the bottom. There's the top. There's the top. There's the top. We breach it, we come back to the midpoint. We're at it, and it's actually confluence with the other major trend channel as well. If we go back to the midpoint, lo and behold, it's 444. So kind of a thing of beauty here on the daily time frame chart. Once again, this is not an indication to short the top of the trend channel. It's to not be an advocate for new money longs chasing the higher highs, and just understand that we're searching for a higher low pullback to develop. There's really nothing bearish about two very, very mild downside days at the top of an overall trend sequence, which brings me to my next point. Thursday is a gap fill reversal. Friday's a pure inside bar. Is there anything aggressive about the downside on Friday? Absolutely not. There's absolutely nothing aggressive about Friday's down day, and we'll see that on the market internals in just a moment as well. I also want to build confluence at this level from the daily perspective with another study set we haven't used in quite some time. If I throw on the anchored view apps from the bottom, right, all the major pivots after the October bottom, boom, 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 so on and so forth, I know none of these are obviously in play. They're just miles and eons away. But if we zoom in and we go to this anchor at the pivot top and this anchor at the pivot bottom, where are those anchored view apps? Lo and behold, 443 and 444. Could we be looking for pullback buys here for a break and retest on the top of the range? And would that make sense in the grand scheme of everything we've covered thus far? I have to say the answer to that question is absolutely yes. If we just build out consolidation and we break, again, it's very hard to advocate for chasing new money longs there, but I'll give you some upper targets, 461.50, 465.25. Let's move on down to the hourly time frame chart. Get a little bit more granular and build the roadmap for like the Monday, Tuesday session. Obviously, not much takes place in here. I do have to give credit where credit is due. On the hourly time frame chart, the sellers did a great job of producing a lower high underneath the double top neckline, aka the low of Wednesday's session. So Thursday, that lower high is a thing of beauty. Unfortunately, on Friday, there's no follow through, right? There's just chop and consolidation. So in between 450.50 and 451.50, I'm not convinced that there's anything easy to do in there from a trading perspective. You could fade the highs, you could fade the lows. Where do the better trades start to unfold? Well, if we usher in the new lower low, meaning this turns into a really ugly, but technically it's their H pattern, the lower low is underneath 451.50, and we could trade for the downside pullback, looking for this. And then, of course, this is the major zone where I do not want you to forget we are looking for pullback buys in this area. We are not looking for new money shorts as we come down towards key support at 444. So that's the downside. A lower low or you could be a little bit more conservative because the nature of the daily trend, weekly trend is so strong in the upward direction. I wouldn't call you crazy for not wanting to take the breakdown of 451.50 and instead waiting for a rinse and repeat of this right here, right? You break it, you confirm it with a lower high underneath, and then you trade for this downside outcome at 448.50. That way you can place a stop loss just above. You've got tight risk reward, right? You're aiming for something that looks like this. All right, so that's the downside trade. Long-sided trades, pie in the sky double bottom, squeeze also if we can take Friday's high out and the lower high out from Thursday, higher lows over 454.50. I think you squeeze out and disappoint a lot of shorts who started to pile in here, thinking that this is it. All right, earnings season is here. It's a miss. Everything's going to zero. Those get squeezed out if we can take out 454.50 in the coming weeks worth of trade. Once again, treat that as a trade, not a new money long from anything longer than like an hour to 2 hour hold perspective. Very tough to have a new money long position at the top of this overall move. Let's take a quick look at the anchored view app, see if we're getting any confluence out of these. And the answer is yes, right? So if we do get the break and higher low over 454.50, the anchored view app from the top of Wednesday would also be getting breached. So once again, the average short position would be underwater if we can take out 454.50, thus furthering the squeeze in the upward direction. You are getting a little bit of confluence here for support at the 451.50, which once again is a pretty darn good reason to not want to go short through it first and wait for the lower high underneath before looking for this outcome. This one's kind of in no man's land, and this anchored view app is still down in our key zone around 444. So the roadmap's clear, not much to do in here. Squeeze over 454.50, lower highs underneath 451.50. You can trade for downside outcomes, but you better believe you should change your tone when and if we approach 444, 443. Let's take a look at some supporting evidence. Exhibit A is the market internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. There's only one thing on this screen that strikes me as being bearish. Let's see if you can find it. To me, it's got to be the cumulative build out of the tick on Thursday only. Even if you look at the volume flows on the Thursday session, the advanced decline line on the Thursday session, they're really more mild than anything else. Don't get me wrong, this is not bullish, but this is really the only bearish thing that's going on here. And even at that, a more substantial cumulative build really scratches at 5,000 positive or negative. The close on Thursday is negative 3,500. So don't get me wrong. I'm not trying to argue that this is bullish. This is definitely bearish, but it's not as bad as it could have possibly been. Especially pair it with the idea that Thursday, it wasn't a gap up. We actually opened right at the prior day's close, basically. And you can see that the volume flows, it should have been very easy for basically most volume on the exchange to count as outflows if we were opening at or below the previous day's close. It simply didn't happen. We never got anywhere close to negative 300 million. Same thing with the advanced decline line. Never got anywhere close down in trend lower zone. The only bearish thing is that intraday the ticks were lower here, and at that, not even negative 5,000, right? Pair that with an inside bar on Friday, totally inside of Thursday's range. This is slightly over the zero line into the close, above the zero line into the close, builds, and above the zero line into the close. Is Friday more bullish or bearish neutral consolidation? I would say it's neutral with a small side of bullishness. Definitely not bearishness, right? We did close weak at the lows, but to me, that's really just liquidation break. You'll notice that intraday got bought up, started to get bought up. I think that people closed out into the weekend not wanting to hold through any uncertainties over the weekend, number one, but also coming into the week fresh for FOMC and earnings, right? You get poor high here a number of times, so longs trapped at the highs. I'll give credit where credit is due, right? There are longs trapped at the highs there, but for the most part, it was not an overwhelmingly bearish day. It was just long liquidation into the close. So are stronger sellers getting involved in this market? Is there anything to be overly concerned with yet, right now, with the data in hand? Could this change with Microsoft? Could this change with Google? It could change once those earnings releases are out, but right now, there's really not any stronger evidence of solid sell-side momentum hitting the market. Even look at net volume flows on the week, just below what we would consider substantial, right? Even after the big sell-off day on Friday, right? 500 million, and we're at 400 million into the close of the week. So all things considered, neutral on this sideways consolidation. It's not even really a pullback. If I just go back to the SPY hourly, this is hardly a pullback. It's really just sideways consolidation through time until proven otherwise. We have our roadmap, supporting evidence kind of agrees with it. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, we want to see what's going on with the Thursday and Friday value area. On Thursday, it should come as no surprise that value is completely breakaway to the downside, leaving Wednesday as overhead supply. That was really the premise for the pullback in the first place, so no surprises there. What's really interesting to me is that, yes, the point of control does migrate lower on Thursday's session, but on Friday, value area is technically above the point of control. The point of control is higher in the overall profile instead of lower. We know that we got liquidation break into the close. You would have to imagine that if this represents new short positions being initiated on Thursday, we could definitely get that squeeze opportunity I was just referring to on the SPY over 450, 450 if we get the move that looks something like this, just noting the location of where the most volume transacted on Thursday. Now, this is not a guarantee that that has to happen, but it just builds the case that it's a reasonable outcome, right? The probabilities are not necessarily increased, but it's reasonable as an outcome to potentially expect. We do have a poor high on the Friday session as a poor low as well. So repair on either side. If we test the high, expect it to break. Do we come back into range or do we get follow through? Just expect it to break here, expect it to break here because they are poor levels. The last thing from the market profile, which is pretty nuanced, and we'll see why when we compare to the NQ in just a moment, but all of the value from the Thursday breakdown and the Friday inside bar is above the single prints from the Tuesday rally. Again, this will become much more substantial when we look at the NQ in just a moment. Jumping back on over to the platform to evaluate the weekly performance of our sectors reveals that more of the defensive names led this week. So energy takes the win here at 3.87%. Healthcare after that, 3.72%. Financials are the outlier. Then we see utilities defensive, staples defensive, right? At the bottom of the barrel, it's communications, which is risk on, down 2.37%. XLY for discretionary, down 2.31%. Real estate's the outlier, and then tech. So risk on definitely faded this week, and risk off is coming back into the picture. But is that reasonable as the market is starting to grind lower here or even just go sideways through time? I would have to argue yes. Now, it's not ideal that earlier in the week there was a substantial break in the upward direction, but we'll get to the structural chart on that in just a moment. Here's the XLE. Any issues from a leadership perspective? Once again, still technically in an overall weekly or even monthly downtrend with something that looks like this. On the daily chart, we're getting some traction in the upward direction, but don't forget, folks, upward pressure is still upward pressure for that good old S&P. The XLE is just such a lightweight sector, it's not going to make or break it. The XLV, this is where some substantial returns were made into the end of this week, particularly after the Johnson & Johnson and Abbott Labs blowout earnings. Merrick also really rallied it, as did AbbVie, which are really heavy-weighted components of the XLV. So they're yet to report. I wonder if they'll fade now that they've already priced in the move. But nonetheless, the XLV, second heaviest weighted sector by market cap, definitely kept your S&P from breaking down more aggressively, more along the lines of what the QQQ did, right? So seeing this rotation, it strikes me as actually more healthy than anything else right now. Don't get me wrong, we could come in for a pullback, but it's going to be a mild pullback if the D for defensive sectors are picking up the slack. And as of right now, it certainly looks like they're picking up the slack. The XLF, it is more of a risk on sector, undoubtedly. Full rotation into the banking crisis breakdown level, right? So is it reasonable that we could see a pullback here? Yes. Does that mean we could see a pullback in the SPY this week? Absolutely yes. Could we catch ourselves for a daily high or low? Once again, the answer is yes. So nothing concerning yet about changing the XLF trend in the downward direction. XLU for utilities. Leadership issues? No. Is it getting out of this range? Yes. Is it taking out this top? No. So all good. We're seeing some rotation. Upward pressure is upward pressure. XLP. Here we go. This is coming in. Is it possible that we could get the rejection off of 76? It's absolutely possible. Remember, folks, the issue is when the move in the SPY itself is being driven by the defensive seeing a big break. The fact that the SPY went sideways on Thursday and Friday, and that's where we're seeing these defensive break out, to me, it's just like, again, that's the rotation trade keeping the spiders afloat while the tech sector cools off and while we get this earnings cycle to go through. Next up is the XLI. Any issues with this chart? Once again, no. Equal high. Could it turn into a double top? Yes. You got to get underneath that neckline. Prior all-time high at 108. That would usher in larger downside. A pullback here could produce a higher low, and we're really just balancing up here. So this strikes me as neutral for markets. And even at that, I mean, we're sitting on all-time highs. Is that really that bearish? Probably not. XLB for materials, stuck in a range. If it breaks and gives us a range double, it's a lightweight sector. It's not going to make or break the S&P. It's also not overly defensive or risk on, so not concerned with this whatsoever. If it breaks, upward pressure is upward pressure. You guys know the deal at this point in time. XLC, worth talking about here, right? Double top underneath the neckline. Netflix earnings absolutely pummeled it, right? So Are we at a key retest level? I would say yes. 65.55. If this can hold up early on in the week and start to rally, it would add some cushion for Google, because Google is technically in the communication sector. It's not in the XLK tech cohort. I don't know why, but it's technically in communications. So if Google earnings are a massive miss, I would start to become slightly more concerned about the XLC, obviously not holding this 65.55. This candle structure isn't the greatest, obviously, closing weak on the lows, but when you close right on a level, you've got to give it a little bit of resolution, right? Can we produce some sort of hammer on Monday? Can we produce an indecisive doji? Will we hold this number is basically the question to ask. If not, obviously you get deeper concerns for a daily trend reversal. Zooming this out, is it reasonable that this has to stop at some point? Yes, markets do not move in a straight line for forever. If we get something that looks like this, if we get something that looks like this, could we get a weekly higher low at 62.20? Yes. Can we trade for downside outcomes in the meantime? Yes. It's not that we're not going to flip bearish when we need to flip bearish. We just haven't made the full turn yet. We're starting to see the signs of the opportunity for a bearish rotation. However, we're not all the way there yet. And earnings will definitely complicate things, right? You got to trade around these gaps, around these announcements. How's the XLY doing? Obviously, Tesla, the big component over here, sending it on the gap down. 3-bar play in the downward direction, big retest level at 167.25. I would not be overly bearish in the XLY until we are underneath that, or until this builds out as a head and shoulders that looks something like this, right? So 167.25 key level, neutral until proven otherwise, looking at this as a pullback. But yes, it does look like early on in the week, the 3-bar play could pan out in the downward direction to get there in the first place. Real estate, really lightweight sector, we're going to skip it. And then the XLK tech sector. What do we see over here? Basically, all-time high was produced on the Wednesday session. Pullback, 3-bar play, same concept as the XLY. If we break down through these lows, is it reasonable that we could trade for some downside early in the week? Yes. Can we catch ourselves for a daily higher low at 173.35? Yes. If we come back further than that, we're producing an equal low, and then the threat, of course, is a lower high underneath 175.70 for, there you go, there's your head and shoulders. Obviously, if we just slice through all of this like a hot knife through butter, it becomes much more concerning. We'll change our tone much faster. But as of right now, given the nature of how we can see that there are not stronger sellers getting active in this market, I wouldn't be convinced that the market's just going to fall off of a cliff like this unless it's from an earnings announcement, which again, 50-50 coin toss. It's up to you if you want to bet on that stuff. I would always advise no. There's no reason to ever bet on an earnings announcement. So that's my 2 cents. That's the sectors. Let's take a look at the ratio grid. Here it is. If you don't know how to set it up, there's a video tutorial in the top right-hand corner for you. Overall, this just does a better job of visualizing relative strength versus weakness and risk on versus risk off. This still looks okay. There's an opportunity to hold at the 50 SMA. If it does not hold, we will change our tone. Risk off is creeping in, still underneath a descending 50 SMA. XLF looks decent, starting to recapture its 50 SMA. XLY, aggressive pullback. We will become concerned when we break underneath the 50 SMA, right? Can you see how this is starting to come together, right? XLC, we had some major concerns about this one as we were near the 50 SMA. Now that we're actually through it, this starts to look more like a risk-off type rotation, right? So XLC is the first one to actually go. XLP is perking up, but is it still underneath the 50 SMA? Yes. Same thing with utilities, same thing with energy. So we're on the cusp of a possible rotation to more of the risk-off style sectors as the market pulls back, but as of right now, we have not made the full turn. We could also illustrate this with something like the XLK, so tech versus utilities, sharp pullback, and undoubtedly a very sharp pullback, but it's coming from a higher high. From a trend perspective, we can catch ourselves for a higher low at the 50 SMA, which is still upward sloping. Is it full-blown risk off yet? No. Is it as pretty as we wanted to see? No, I would concede that point as well. And the same thing can be said about XLY versus XLP, so staples versus consumer discretionary, sharp pullback. But again, ask yourself the question, are we coming from a higher high? Are we above an upward sloping 50 SMA? The answer is yes. We're on the cusp of a potential risk on to risk off shift, but we're not there firmly yet. How about the dollar? Still an opportunity here for a big time lower high. It would be great if it were underneath 101, but there's any opportunity for a lower high underneath 103.50, the midpoint of the prior range. And if we take a brief look at what's going on with the gold contract, this would also agree, right? If we take a look over here, you're getting kind of inverted head and shoulders like this, break and retest on the 1955 level, looking to see if we can put in a reversal intraday here around 1955 to get back up towards the neckline and ultimately breach 2000 again in the upward direction. Just as a piece of supporting evidence as well, we'll take a look at the silver contract, which we brought up in last week's video. Just an update here, right? You can still get the break and retest trade, but what I'm getting at is if silver needs to make the move here and gold kind of goes sideways and then silver kicks off the rotation higher on the big break and retest of the level, that would bode well for the dollar trying to find its lower high, right? So putting the pieces of the puzzle together, it's not the end of the world for equities down below just yet based on metals and the dollar. Let's take a look over at the TNX. There's really not much to report here, especially with the FOMC already being priced in. We know we've really just gone sideways in here. We'll probably get some movement out of it on FOMC, especially when Jerome Powell is on his press conference. PCE will move this obviously on Friday as well. We can take a look at the ZT. I'll just continue to bring up the ZT inverted until we actually produce that lower high. We know that the outcome we want, if the Fed is truly only going to be one and done into the end of the year, is a lower high here and then a flush of these lows at 102.015. All right, so that's what you need to see happen there to be more confident that the Fed is going to be one and done into the end of the year. Speaking of, let's just take a look at the tracker tool now. No surprises, we're locked and loaded for the 25 basis point rate hike here, and even if we go out to the November timeframe meeting, we know that we are back to a pause for November. This is where there was an issue with pricing in more of another rate hike, and that has diminished over the previous week. I really think there's not much to update on until Powell actually comes out and speaks. We will be getting PMIs early on Monday. Manufacturing PMIs are already in contracting territory underneath the 50 mark, so we know that goods inflation has been tackled already. It's kind of a non-issue right now. It's really the services inflation, and flash PMI for services is still above the 50 mark here, albeit slightly underneath. The forecast is slightly underneath the prior at 54 versus 54.4 prior. So we'll keep an eye on that. Maybe that causes rates and expectations for rates to shift around a little bit, but undoubtedly the fireworks will be here, and of course GDP and then PCE on Friday. Even at that, it feels as though, just in terms of what I'm hearing from people, in terms of how the market's reacting as well, it's much more so all about earnings right now than anything else. Microsoft, second heaviest weighted stock in the S&P, obviously a huge weighting of the NASDAQ as well. Same thing with Alphabet, right? So it's going to be a loaded week here out of tech, out of communications, Visa for the XLF now. Don't forget it. Visa and MasterCard are in the XLF now, rightfully so. Meta is as well, right? So it's going to be a loaded week out there. And I think that this is what the market wants to focus on, not so much the 25 basis point rate hike that everybody has seen coming down the pipeline for like months and months on end. So earnings will be your top watch for volatility in the coming weeks worth of trade. How about the risk appetite of the market? The TLT ratio to the S&P certainly drifted lower into the end of the week, even as markets were pulling back. So it speaks to just fine risk appetite. And even if you don't believe that this ratio is relevant anymore, we can take a look at short dated bonds versus longer dated bonds. This actually ticked lower into the Friday session, ticked sideways into the Friday session, certainly not making aggressive new higher highs on any of the earnings announcements, right? So risk appetite overall, nobody's really sniffing out a recession right now based on what the bonds are doing here. We could take a look at high yield as well, junk bonds here. And we remember that there was a divergence as we were moving into that equal high on the S&P from Wednesday. So that played out just fine. Not really seeing anything glaringly wrong with this chart right now. I mean, these are obviously higher lows from here to here, playing nicely with the idea of higher lows out of equities down below. So again, mild pullback until proven otherwise. Don't forget that the S&P has hardly changed on the 2 down days, Thursday and Friday. Let's take a look at the Bitcoin chart just to see what's going on over in crypto land. How did it hold up as the earnings announcement came out? Let's take a look at the daily. And again, like nothing crazy here. It's not one-to-one with risk appetite down below, but in terms of financial markets and risk taking as a whole right now, this did not fall off of a cliff with earnings. It's just mildly sideways. And even remember, we've got thin structure off to the left. So supports the idea. It's a mild pullback until proven otherwise. Market breadth to me is absolutely fascinating because as everybody's worried about the pullback in the tech cohort, which don't get me wrong, it is a very heavyweight cohort. Look at what breadth did. New highs versus lows actually ticked higher on the week, but it gets better than that. If we take a look at the SPX A200R, big tick higher on this week's session, right? So as everything's breaking down in tech, the majority of stocks in the S&P actually reclaimed more of their 200 SMAs as opposed to lost their 200 SMAs. If we take a look at the SPX A50R, this gets even better, a new higher high into the end of the week. It's very nuanced, but it is there. You are getting a higher high. So as the pullback unfolds, breadth continues to improve. The only Armageddon type sell-offs that you'll you'll ever see in the market. The only time it ever happens is when quite literally everything is moving in the downward direction. So to see breadth actually continuing to improve as the tech cohort pulls back is really encouraging. If we take a look at the RSP, looking over here, once again, a brand new higher high on the Friday session. Not a closing higher high, but we did produce an intraday higher high out of the equal weight S&P 500. Is there an opportunity for a higher low pullback? Yes. New higher high? Of course. Higher low is on the table. And we could also take a look at something like industrials. If we go over here and zoom in on Dow Industrials, more time over the breakout point. Instead of some sort of fake break, we were concerned on Wednesday with the inverted hammer that, hey, maybe there's a pullback into the end of the week. We test this breakout point, and if we fall underneath, it's not great. Technically, we could get a higher low here, but look at what happened. We remained higher and above into the end of the week. So once again, breadth continues to get better as the pullback unfolds. Rotation stays alive. Market's not really going to break down aggressively if you're getting rotation, if the breadth continues to improve. VIX volatility didn't even bat an eye at the Thursday breakdown, given what took place with earnings. Kind of surprised by that, to be honest with you. So we'll take a look behind the curtain one more time because, oh no, zero DTEs broke everything, right? Well, the VVIX also did not bat an eye on earnings from Thursday. We're actually still in this very healthy area for the VVIX. We're not pegged down below at complacency zone where things get dangerous at 75. So that strikes me as being just fine and dandy. And even for the purists, if we take a look at volatility futures, don't get me wrong, a mild move to suggest that maybe we're moving closer to a backwardation, but to be in backwardation, you need to be above the zero line. Not even close. Not even close. Look at the 9 versus 30-day VIX curling underneath the zero line, so no backwardation here. And even the 1-day VIX volatility index, right? For all of those naysayers who say that zero DTEs ruined everything, we've had higher reads in the past outside of what took place from Netflix and Tesla. So I'm just not seeing the reason right now where volatility is this magic answer for a larger pullback to unfold. Thus far, I think we're on the right track here with, hey, new money longs, probably not, but we're not seeing an Armageddon type crash coming around the corner. QQQ weekly time frame chart. What do we see here from a candle structure and location perspective? Very similar to the S&P, obviously, with a weekly inverted hammer, but this one, of course, has a red-bodied bar. So what does it mean? Of course, we go from the highs to the opening print, but this time through the opening print for an extremely weak close down at the bottom of this week's range. No surprises that there's more weakness out of the NASDAQ, considering that there is no diversification from a sector perspective with things like energy, healthcare, or financials to pad some of the losses from the Netflix and Tesla earnings. On the bar-to-bar count, how did we do location-wise? Certainly a substantial higher low as well as a higher high. So not really seeing the argument for an Armageddon-type sell just yet. We're still very much so in an overall weekly uptrend with a brand new higher high being produced. The most interesting thing on the QQQ weekly time frame chart would be a look above and fail back down underneath this breakout point. We'll see that on the daily as 372.75 in just a moment to target the soft lows here at 360. Once again, the reason they're called soft lows, or I'm calling them soft lows, is because we never actually flipped into a daily downtrend here. So 360 is interesting from that perspective, but also we get confluence with none other than the AI Mania anchored VWAP. This is when all that nonsense gets kicked off, and there it is at 359.67 as of Friday's close. So 360, very interesting. If we can break the low of last week, fall into the range, in which case we would target the bottom of the range, which is also confluence with the anchored VWAP. Let's take a brief look at the volume profile and see if this is telling us anything insightful. Not really. This high volume node is smack in the midpoint of that balance range we were just referring to. You wouldn't really want to initiate new trades in the midpoint of a balance range, and this high volume node here is what caused, or maybe not what caused, but it's confluence with the rejection at the upper wick of the previous week's worth of trade. So things are making sense structurally. This high volume node, hate to be that guy, but once again, let me zoom in here. We know that we're in a very strong weekly uptrend. These are soft weekly higher lows. These are hard weekly higher lows because we did get a daily downtrend in that lower wick right there, albeit very short-lived. Technically, higher lows on the weekly time frame chart could go all the way to 320. Is this ideal? Is this optimistic? Is this easy to trade? Absolutely not. But from a trend count perspective, just your friendly reminder, 320 could technically offer a higher low. Let's go ahead and bust out the Fibonacci's from the all-time high to the low here, just to be congruent with what we did out of the spiders. 61.8, not really in play, even if we go to the 360 target in the coming week's worth of trade for your look above and fail. As we know, the more time that we spend above the 61.8, the greater the odds over time hoping that we do get the 100% retracement, not calling for all-time highs this week, next week, or the week after that. But over time, the odds certainly increase the more time you spend over that 61.8. If we come in with the fib from the October low to the top here, let's just say that this ultimately does mark the high. Where's your 38.2 bull flag consolidation, keeping markets healthy? It's still well above 320, obviously, but it's 340. Right? Is the market going to go to 340 this week? Unless Google announces, hey, we're shutting down shop and we're not going to open the doors again until 2030. In that case, the NASDAQ is probably drilling for zero. But jokes aside, don't really see the Fibonacci's coming into play in the coming weeks worth of trade. Let's take a look at our daily time frame chart here and get a little bit more nuanced and granular with some actionable setups into this coming week's worth of trade. Let's throw that on and let's zoom in here. Great. What do we see here from an expected move perspective? Certainly the suggestion of a lower high. The upper bound this week is at 384.36, excuse me, and the lower bound is suggesting a higher low, very nuanced, but technically there at 366.91, call it 367 even. So a bit of a more neutral expected move, unlike the S&P, which is definitely more bullish. Your picture perfect pullback level for the break, retest, and higher low is at 372.75. So if I was just talking about the more aggressive downside rotation to the bottom of the weekly range at 360s, this kind of is a conflicting argument. So what would you have to see for the 360 level to come into play as I look above and fail? It's got to be a daily lower high underneath the level for something that does this over time. The stronger short indication out of your QQQ is letting this turn into a daily downtrend with a lower high underneath the level before starting to action off of that sort of setup, right? So that's your daily perspective. Certainly a gap fill reversal on Thursday would indicate that the sellers did their job. The buyers also did their job, right? They corrected some of the oversold territory in the overnight range, and then the sellers ran away with it with follow through from Tesla and Netflix, obviously. And then on Friday, it's an inside-esque type bar. Technically, we sweep the low by just a couple of ticks there, but it's underneath the 50% retracement of Thursday's range, setting this up as a 3-bar play in the downward direction. Once again, do you want to be an aggressive new money short into this daily level that could potentially act as support at 372.75? Not really. If we take out the anchored VWAPs from the major pivot bottoms, there's your pivot top and pivot bottom, which are offering confluence at the 372.75. So still building the case for this as a higher low pullback, viable place to be looking for a setup. Let's go to the hourly chart here. I want to be very clear because I didn't mention this on the SPY, but hopefully it speaks for itself. We're not just closing our eyes and blindly with both hands buying 372.75 or the 444 level in the SPY. You still need a setup here, right? Just because it's the ideal location doesn't mean that we can just blindly buy it. You need a hammer, you need a double bottom, you need an inverted head and shoulders, you need all that good stuff. So watching this, and the main point of bringing this up on the QQQ is that your downside is actually limited. The risk-reward profile for new shorts here is not great as we're coming into this 372.75. The time for new money shorts was the gap fill reversal on the Thursday session, right? Or the breakdown underneath this low, or the rejection on Friday morning. That was the time to capture the short move in the downward direction. Don't get me wrong, there's a little bit of range to trade for there if you're a scalper, but the odds are actually better for risk-reward profiles in the upward direction off of 372.75 retests on your daily time frame chart. If you can spot the setup, that's what you're watching for. So what else is in play here? As we talked about on the daily, lower highs underneath, kick off the look above and fail on the weekly time frame chart. 360.50 on the downside is in play on that type of move. And you can also get the squeeze, just like we talked about in the SPY, the squeeze over the anchored VWAPs. You could do the same thing like this over the QQQ. That number is 378.50. If I throw on the anchored VWAPs, you can see this stuff. So here we go. Notice that these are all coming in for confluence around that area. If we can break it, if we can go higher, low, above, anybody who is short or quote unquote the average short from any of these positions is now underwater. So higher low over 378.50 kicks off the squeeze. I would target 382. Let's also take a look now. This is interesting and very nuanced, but VOLQ, volatility of the NASDAQ. The reason I want to bring this up is simply because, if you're arguing that, again, the VIX is broken, even NASDAQ volatility didn't even budge higher on the Netflix and Tesla announcement, right? Nothing really went on there. If we take a look at the flex grid for our market internals out of the NASDAQ side of things, much more aggression on the sell side move from Thursday, deeper than what we saw out of the NYSE side of things. But again, to be expected when we're dealing with a heavily tech concentrated sector. Basically is the tech sector, right? So nonetheless, a little bit of bearishness on the Friday neutral consolidation day, where this is underneath the zero line instead of the S&P, which was mildly above. This is underneath the zero line, which is the S&P was mildly above. And obviously your cumulative build out of the tick is flat on Friday as well. Let's take a look at the NASDAQ futures through the lens of market profile. This is interesting to me because remember, I sort of alluded to this over on the ES side of things, but here's your double distribution from the Tuesday rip, if you will, from the Microsoft AI pricing model leak, or whatever you want to call that day, right? Notice all of the value from Thursday and Friday are underneath the point of control from that Microsoft day. So anybody who is trying to chase that rally out of the Microsoft move in the NASDAQ futures is underwater and feeling pain as of Friday's close, right? Also, you're not getting this value area on Friday, which is massively above the point of control like what we saw out of the ES side of things. So if you're going to look for weakness, obviously the tech sector is the place to do it. Please just understand that on the daily time frame chart, you probably want to see something that is a little bit more friendly for short-sighted risk reward, which is a break, retest, and lower high underneath 372.75 before fishing for, your larger downside outcomes. IWM weekly time frame chart. What do we see here from a candle structure and location perspective? Much more similar to the SPY as compared to the QQQ, with a green-bodied inverted hammer. The sellers do certainly still step up in that upper wick, but they're only able to close prices right back down at the midpoint of the week's range. On the bar-to-bar count, we certainly get a higher low as well as a higher high, and we are breaking out of this as a weekly balance towards the top of this as a weekly balance. So is it logical that the sellers are stepping up at a reasonable place here? Absolutely. We also know that from a VWAP perspective, we've broken out of a pinch on the weekly time frame. So this range was actually a pinch of anchored VWAPs, the October low and the all-time high. The pullback obviously wants to stay above that to do something that looks like this into the future. That would be the most optimistic look for the IWM as we move forward. That anchored VWAP is currently sitting at 189.32, and the top of the range, as we know, is closer to 188.25, I believe, if my memory serves me properly. Let's take a look at the volume profile here. Anything interesting? There's that strong volume support base underneath us. Also, the top of the weekly range that we just broke out over, the anchored VWAP confluence as well, is a high volume node, right? It's the top of that node. And where did we reject? If I drag this across, the upper wick of last week's bar is right at this as a high volume node. So everything's making sense structurally here. The one thing that we need to do to stay congruent with what we did out of the spiders and the NASDAQ, of course, is unfortunately the Fibonacci's, and you'll notice that we are just now testing the 38.2. So if we reject here, it just keeps us in bear flag consolidation in the grand scheme of things. You really got to get up and out of this from the IWM perspective if we're going to get in gear. If we throw this Fibonacci on, we've talked about this in the past as well, if we can pull back and stay above the 61.8, that would be constructive, and it's also confluence with the anchored VWAP as well as the top of the structural range here that we just broke out of and the top of the high volume node. So everything really stems from 188.25. Let's go to the daily chart now actually and see if we can see that with a bit more clarity together on IWM. There we are, and we'll take a closer look. Let's get granular, zooming in. So expected move is bullish, higher high or higher low, and there's that level 188.25 that I was just referring to. If we can stay above that, this is the weekly range that we just broke out of. You get a big break, retest, higher low, and you're kind of good to go from that perspective. So watching out for 188.25 as your key line in the sand. Something interesting for me already that I'm making note of mentally is on both sell side days, we never actually attempted 193.50. That's like a rainbows and butterflies pullback out of the IWM. If we can consolidate up here, I mean, my goodness, you get a range double from this to this, and if you rinse and repeat, right, that starts to get you up and over the expected move, brand new higher high. The daily uptrend kind of continues, and we get closer to that 200 target from the weekly time frame perspective. Let's take a look at the hourly chart here and see what we can see. The IWM has been incredibly volatile. The IWM has been kind of like, if you don't nail the opening move, there's no sense in even trading it into the close. So the way I'm using the IWM personally over the past couple of weeks has just been as a gauge for broad markets, right? It's a big liquidation break and then consolidation. It's a big short squeeze and then consolidation. Short squeeze and then consolidation. This is really just balance, liquidation break, balance, liquidation break, balance, right? So it's really, really tough to actually trade this thing. If we're lower on the day, it helps build the bear case. If we're higher on the day, helps build the bull case. I would really not overcomplicate it out of the IWM. These moves are, again, unless you're swinging something overnight, nearly impossible to catch unless you're quick draw McGraw on the opening bell. If we take a look at the Russell internals, mild, I would say that they're almost more similar to the NQ side of things with the damage that was done here instead of being more neutral on the Thursday session. But if you look at the cumulative builds, they're all mildly lower. None of them are like blowout days in the downward direction. So once again, pretty tough to read this in terms of intraday activity. If we're over the opening print, favor longs. If we're under the opening print, kind of favor shorts and use that for your broad market. Here is the market profile just to illustrate, again, that volatility. P-shaped profiles, B-shaped profiles back to back over here, prior Ps, and then, this was in the face of a B shape, which was in the face of a P shape. So once again, the volatility and all of this happens in the first 30-minute period. That's the A period, of course, out of market profile. Very, very tough to capture those moves. Once again, treat this as a directional indication for markets. If we're, getting that strong push and we consolidate, you probably want to be looking for shorts. If you get a strong push and let's say it's the opposite, it's a P shape into Monday, you want to be looking for longs, right? Keep it simple in the Russell. If you've made it to this point in the video, I just want to let you know there's a couple of card holders left. I'm honestly surprised that they didn't sell out instantly. However, if you want to get your hands on one, it's the first link down below in the description, tradebrigade.co/cardholders, tradebrigade.co/cardholders. With that said, Apple is up first on the chopping block. As we pointed out on Wednesday, it could not avoid the AI bug. It got bit and it produced a brand new all-time high. And things look fine and dandy here on the daily time frame chart. And sure, we could technically find ourselves a daily higher low over 191. But if we get a little bit more granular on the hourly time frame chart here and zoom in, the concern is that you have a lot of trapped overhead longs here on this head and shoulders pattern. If we're producing consistent intraday lower highs under 192.50, I would be looking to trade for downside outcomes here. Things like a daily higher low, a little bit lower, right? That would be 189.25. That setup is on the table. Where's the long? The long is only if these longs start to become happy once again, which means moving back into range, but that's not enough. You need the higher low over the right shoulder at 194.15. So a lot of work to be done out of Apple if this is going to continue in the upward direction. It will, of course, be sensitive, I'm sure, to Google and Microsoft earnings. Let's take a look at Netflix. How much damage was done here? Quite a bit. Lots of overhead supply, lots of disappointed longs from this move over here. Even opening at the top of the range, you would have had to imagine that some folks were thinking, oh, great, pullback buy opportunity at the top of the range. As a matter of fact, I thought maybe there would be an opportunity to fade some of the gap if we got the higher low over the pre-market. Let me just show you this here. It's easier to just show it as opposed to just talk about it, right? If we got the higher low over this level, right about here at 455, it was game on for like a partial gap close. Maybe not all of it, but a partial gap close, right? We're holding the daily support at the top of the range. We're over the pre-market high from the bounce, right? Absolutely did not unfold that way. So if I just turn this back off and deal with the chart in front of us and the story that we need to tell ourselves based on the data in hand, this as an overhead range, we're now underneath that. So what does that mean? Lower highs under 431.50. It's game on for further downside. Obviously, you're now flipping into a daily downtrend. A big time lower low was just made here, right? Lower low, obviously strong opportunity for lower highs. Anything that does this, even if we do rally into the range, I don't think there's a trading opportunity there because it's too choppy going through something like this. However, if we produce a lower high and come back down for the equal low flush, it's game on. A lot of damage was done in Netflix in terms of the daily trend being able to reverse here with a lot of trapped longs at terrible location up at those highs. Let's take a look at Tesla. And it's a similar comment over here, just in the sense that you already have a substantial lower low. It's very possible that we put an hourly bear flag consolidation here and go back down to the equal low of this head and shoulders neckline. Remember that at that's 243.50. And then the only time that the bulls really have something going on is like maybe if we do this, we can start to retrace some of the thin structure from back here, but I wouldn't be betting on that, right? Let's take a look at the hourly chart now. You can see like maybe if this turns into a double bottom like this, a higher low gets us through the thin structure, we could target the bottom of the gap. It's a possibility, but with the big time lower low and disappointed longs from up here, I'm not thrilled about that as a primary outcome early on in the week. So taking this one day by day, neutral through here, higher lows, skeptical longs, lower highs, it's game on 243.50 with the lower low that's already in play here. Let's take a look at Google. This one deserves the daily chart to start. Obviously, earnings are going to be an issue on this one early on in the week, but just to point out, is there any trend going on over here? Absolutely not. So without a trend, without having earnings out of the way yet, this is a no touch early on in the week. We're not even going to dive down to the hourly. Let's take a look at Metaverse. What's going on over here? Beautiful double top. Earnings are on Thursday, so you could trade this one maybe Monday, Tuesday. I would start to ease off as we approach the earnings date there. This one's interesting because it's definitely in a bearish hourly structure. If we just go there, actually, I could show you. Here's the double top, as we just discussed. Clear breakdown of the neckline. As we say, it's not a double top until it is. You need to break the neckline. That's exactly what happened on Friday morning. We also got intraday a lower high underneath the top of this prior range from in the past at 297.25. So the issue with Meta is that the downside has already been played, and the daily higher low is possible here at 288.75, the top of this prior range, right? You get lows here. Can we produce a daily higher low for a big old break, retest, and then do something like this? It would probably be more like a weekly. The daily was this one in here, but you get the gist, right? This area of support is certainly interesting, and I think that the short has already played out here. I would not be chasing Meta shorts into this, and I certainly wouldn't touch it as we get closer to earnings. Next up is NVDA. What's going on with NVIDIA? Same concept, right? There's your big daily break and retest. Can we find some support around this gap close? Here's the hourly chart to get a little bit more granular. This is an area of support. The short this one was not really an easy short to pick off unless you grabbed that lower high into the Friday afternoon session. I certainly did not. I would not be an advocate for trading into the last 3 hours of a Friday, but to each their own. The lower high under 452 structurally, though, it is significant. Like, we can't just brush it off as being insignificant. It definitely is, and we're underneath the neckline of the double top. But again, the daily issue is the break and retest higher low at 436.50. This, I believe, will be much more closely tied to Microsoft earnings with the whole AI mania. I would be very cautious of NVIDIA ahead of Microsoft earnings, basically, is what I'm getting at, because I think they're going to move in lockstep. Whatever Microsoft does with the closest partnership to OpenAI is going to have the biggest impact on the AI space as a whole, and NVIDIA is the beneficiary, right? So I would be watching that very closely, treading with a lot of caution out of NVIDIA. I would say that the Meta higher low is more tradable with earnings later in the week than NVIDIA with the sympathy move to Microsoft, which is happening earlier in the week, right? Let's take a closer look at Microsoft. Speaking of, so there's your AI pricing model. The cat's out of the bag. I think that the risk for Microsoft is all downside, personally, right? If the cat's out of the bag with the pricing model, unless they come out with some, heavy hitting news that's like, hey, we just threw you off on Tuesday of last week. This is actually what we're going to do. And it's, rainbows and butterflies, blows that plan out of the water. I think the risk is to the downside, right? You're already getting sort of look above and fail. Look above and fail. We're back in the range. We did not hold for a higher low above 351. You've got disappointed longs up here. I think that this is total risk to the downside. Again, I will not be trading this ahead of earnings. We'll be watching closely. But an interesting level that you're going to want to watch to resolve is 342.25. That's been the level where all the plays have been happening off of. And on Friday, we come right down to it. We start to support. That's the key number, right? It's where all of this stemmed from. Double bottom neckline break. It was playable twice over here for a rinse and repeat. Now we're there again. 342.25 top watch. How do we resolve it? Up or down? If we're up, there's still the threat of lower high underneath 351, right? So not in love with the Microsoft setup, especially with this move, which has faded more than 100% ahead of earnings, right? So I think the risk is to the downside. But once again, I will not be a 50-50 gambler holding calls or puts. I will be flat through every single earnings announcement, always. Amazon. What's going on? Last but not least, the mini beast. Double top, same idea. There's your neckline underneath, lower high on the Friday session, inside of range as well. So this to me is an opportunity for the bears to prove themselves. And by that, I mean we need to produce the daily lower low underneath this area, right? So a breakdown of 127.75 gets very interesting with the hammer on Friday. I'm not convinced that it's here yet. If we go back to the hourly, this is choppy, lower highs that flush, great, there's the proof. If we go higher low back above, you start to retrace the thin structure. I would just walk these levels up, 132.70, 134.40, and then the ultimate target would be the double top once again at 136.75. So overall, this week's going to be tricky to navigate. I probably, I'm just being honest with you, 9 out of 10 trades will probably be in the broad market ETFs, right? Be it SPY or Qs, NQ or ES futures, doesn't matter. That's probably where 90% of the focus will be in the coming week's worth of trade. If you've made it to this point in the video, I of course want to take this moment to thank you, the viewer, for joining and being a part of this awesome and unique online trading community, be it in the pre-market live streams, down below in the comments section, in the Discord, any way that you interact with the Trade Brigade. It really means the world to me, so I appreciate you tuning into the show. TTD is up first on the chopping block for our trade ideas, and this is a reminder trade idea where we have ourselves a range, and it did start to break down. We did close the gap that we talked about on Wednesday, and now the idea is that we have an inside inside inverted hammer from Friday, setting up a 3-bar play. If we take out these lows, looking for the continuation move through the thin structure, let's see it on the hourly time frame chart. There we go. There's that beautiful rejection in the upper wick, lower high into the afternoon, flushing the lows here. What's the number? I'll give you the number here at 83.68. If we can take that out, looking to retrace the thin structure down towards 78.85 on TTD. So short trade idea, not interested if we start to get trading activity back up and over 86.55. Any consolidation in here really does keep it alive, but you would just wait patiently for that flush, right? Next idea, an original one, is on AMDizzle. Honorable mention over to AMDizzle. Let's start on the daily time frame chart and just understand that there's the opportunity for a larger trend reversal here. You've got highs, you've got lower highs, you've got lows, you've got lower lows. If we can flush the lower lows, you're looking for a decent chunk of a move down towards 100, the nice round psychological number, which was also a prior breakout point. Resistance, resistance, break, right? So 100 becomes the target. Just like what we saw on TTD, we have a beautiful 3-bar play, but this time with an inside doji on Friday instead of the inverted hammer. If we take it on down to the hourly now that we understand the structure, a day trade scalp is underneath 109.70 for the 3-bar play to pan out. The target intraday would be 107.50, and if we go through 107.50, we know that over time, $100 comes into play as a target. If we go back to the daily chart, I know I'm flipping through time frames like a madman, but it might look something like this. There's Monday on a big breakdown from the 3-bar play. Lower highs underneath are then tradable to 100 with a stop loss here if you're taking this as kind of like a 3-to-1 type mentality on the risk reward profile. Last but certainly not least is going to be on Johnson & Johnson, the big breakout trade in the healthcare sector from the earnings announcement on Wednesday after the close. What do we see here? Big move in the upward direction. So how do we trade this? It's looking for pullbacks above the neckline of this as a really sloppy but there inverted head and shoulders. 166. If we can pull back and test at any higher lows above, are tradable for this momentum move in the upward direction, especially if the broad market, or S&Ps I should say, are going to start rotating more so into the defensive categories. Johnson & Johnson definitely falls into that sort of subset of sector. So 166, there's nothing about the chart currently that would suggest a pullback is imminent, but watching for some sort of buy-side setup on pullbacks that are above that level to capitalize on some of the momentum. That is going to wrap up today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by leaving the video a very simple thumbs up. I hope to see you in the pre-market prep on Monday at 8:15. And with that said, I wish you a green trading week.